Okay, accounting 2 kiddos, welcome to chapter 2, section 1, which is on departmental sales on account and sales returns and allowances. So a lot of this should just be review from our accounting 1 stuff. However, of course, we're working with those departments again, so things are going to be a little bit different, but should be a pretty good review for us. So let's take a look. Remember, the reason that we're doing these departments is because managers want to make sure that we use departmental data to make sure we're making the right decisions for our business operations. So just as a refresher, our company, which is Wiley Outdoor Living Inc., is organized into departments based on the different types of products they sell. So there are two categories, remember, grills and furniture. So Wiley's management team is going to use the departmental information that we're doing to analyze if each department is profitable, to set annual goals, probably like sales goals, evaluate managers, and determine company bonuses, things like that. So it's really important. Companies use it quite frequently in order to make sure that each department is doing well. So in order for us to make sure that we have comprehensive departmental data, meaning that we encompass everything, a business should record sales and cash receipts data separately for each department. So remember that all departmental sales of merchandise on account get recorded in the sales journal. That should be a review from accounting 1. Their sales journal, though, is going to have two sales credit columns. Okay, instead of just having our normal sales, we're now going to have sales for grills and sales for furniture. The one that doesn't actually get split into departments is sales tax. And because sales tax is not actually kept by our business, remember that it goes to the government, either the federal or the state, we don't actually need departmental data on that, so we keep sales tax in one account, sales tax payable. So Wiley, of course, records all departmental sales at the time of the sale, regardless of when payment is received. And of course, that's the accounting concept of realization of revenue. It simply means that we record things when they happen, not when cash is received. That's, of course, the cash basis of accounting. What we're doing is the accrual basis of accounting. So, of course, realization of revenue just states that revenue gets recorded at the time of goods or services are sold, and cash can be received at the time of sale, or, of course, it can be paid on account later. So here we have some information. It says on July 4th, we sold a grill on account to Lynch Construction for $985 plus sales tax for a total. So what's happening here is our accounts receivable is going to go up by the total. Our sales for grills specifically is going up by the $985. We have some sales tax to account for, and then of course Lynch, it says paid or sold on account, so they did not actually pay us, so that's why the accounts receivable is going up. So here you can see, for example, we put Lynch Construction in, our sales invoice number is 793. And then we put our grills. This is what I was talking about, where sales gets broken down into two categories. So we have sales for grills and sales for furniture. We also have our sales tax payable, and then of course the total of those two is going to be the accounts receivable. On a separate note, I want to see if there's anything else on here. Oh, it's just going to point these silly things out. Okay, we're smarter than that. We don't need the fancy PowerPoint. The one I want to point out down here, now that those things are kind of in the way or out of the way, if, for example, we have a company that buys from us on account that is tax exempt, just remember we don't record any sales taxes, and then the same thing happens. This one happened to be sales for furniture, and then the accounts receivable debit goes up for the exact same amount. There's just no sales tax being recorded. Okay, then for our totals in our sales journal, we total each one just like we always have. Of course, the only difference is that our sales is going to get broken down, of course, by grills and by furniture. So each one of those are going to have to go to a separate sales account. We keep that because that's important for departmental data. So once you do the posting individually, of course, you'll come down and do your totals, going to our general ledger. And of course, we remember how to post. Don't forget to put sales is S, so S7 tells us we're on sales journal page 7. Other than that, we're very smart human beings and can remember how to post beautifully, so I'm not too worried about that. Okay, let's revisit what happens when a person that bought something from us on account, or it doesn't even have to be on account, I should say. What happens when a customer returns merchandise to us? Because that definitely can happen. just a second. I don't know if you can hear that. Sully is definitely playing with a toy. I'm gonna tell him to be quiet real quick here. Okay. So anytime that a customer decides to return merchandise to us, we don't want to take that directly out of our sales account. Instead, we want to have a separate account where we're able to see that information better. So, of course, what happens when a customer returns something? The accounts receivable is going to go down with a credit, and then the vendor, which is us, creates what's called a credit memorandum, which just is going to show the amount that gets deducted for the returns and allowances. Of course, we have to do that. That's the accounting concept of objective evidence to make sure that we have a source document for all transactions. Because this does not affect sales and it does not affect cash receipts or cash payments or purchases, it means that we're going to journalize these in our general journal. So here's an example of a credit memorandum. Remember Wiley, that's us. We make it for Taylor Apartments. It seems like they bought one gas grill from us for $2.95 and they are returning that. So not only do they have the merchandise that they returned, but they also have the sales tax. And this $312.70 is the amount that needs to be either refunded to them or taken off of their accounts receivable. So this is what it looks like when we journalize it in the general journal. Remember that we always do our debits first. So sales returns and allowances, of course, is a contra account to sales. So it has a debit balance for the total amount of that grill, which was $2.95. The sales tax payable, of course, is going to be debited because its normal balance is the credit. Again, this is all coming from this credit memorandum right here. They don't have it on the same slide, but that's where those numbers are coming from. And then, of course, accounts receivable for the customer, which is Taylor Apartments, gets credited or brought down for the total amount of those two, which is $312.70. So as I kind of already said, sales returns and allowances is a contra account. So we make sure that we put that there. The sales returns and allowances, because that is departmental data, that's information that we want. We will break that down by both grills and by furniture. So notice that we have separate accounts for each of those. And then, of course, when we post, the only one I really want to touch on is making sure that the one for accounts receivable and Taylor's Apartments, that's one where you're going to have to do the slash because that $312.70 actually goes to two places. Remember that it's going to accounts receivable and it's also going directly to our customer account for Taylor Apartments. So all we do is we do the same posting procedure. It's just that we draw that slash and put 1205 and 175, the two account numbers for those two accounts there. All right, that's all I have for the lecture today. You can head over to 2.1 and do your work together.